the large video that I see to my audience and hide the other video feeds. New guests in my large group. Okay.
All right, we're live. So you want to get off the screen share as we're in the early part of this?
All right.
Yeah.
All right.
All right. All right. Let me see if anybody's joined yet. I'm going to go on the watch page if people have. Thanks for joining. I'm Daniel. This is Scott Phillips joining me. He's going to be doing this webinar today. And yeah, I don't know if anybody's joining us yet, Scott, so we'll just give him a soft hello for now.
Hey guys. It's real early here in the morning where I am. It's 10 minutes to 6, which is all good. The markets are just closed. Really interesting stuff going on today. So yeah, I'm looking forward to showing you some cool stuff.
Okay, so it looks like we got about 5 people on right now. So just slowly people are starting to trickle in. So we should be good to go in a couple of minutes here.
All right, man. You let me know when you're good.
All right, so it looks like we got a couple of people joining. Already got a question for you, Scott. Someone's curious, did you learn price action on your own or if you learned it from someone? So I guess you want to give a little background maybe before we start about yourself and everything.
So I learned primarily off this one dude who was Daniel, and both Daniel and my first mentor. His name was Ivan Krastens, and then later on I spent a lot of time with Al Brooks, who's a guy you might have heard of, and a very brilliant lady called Linda Raschke, who's one of the people in that Market Wizard book, who's an extremely good short-term trader. I never used her method, but I sat in her chat room for like 6 months, waking up at midnight to do it. And so I so my stuff, I guess you'd call it a synthesis of Ivan Krastens, Al Brooks, and Linda Raschke stuff. And but we have
with some Van Tharp sprinkled on top.
Well, a little bit of Van Tharp. I took a lot from Van Tharp, but we're a bit more system oriented than some of those people are. So well, Linda's not
mechanical, yeah.
So I'm very system oriented. I'm gonna explain everything as soon as I get the go ahead to start.
Yeah, it's give us about 5 to 8 minutes. We'll get started right on time as people trickle in.
All right.
You already did a check of the markets today, or you'll be doing it for the first time on the call?
I took a brief look this morning. Everything's copacetic. My trades made money overnight, which is always nice, and yeah, and here we are.
Any stop outs overnight?
Nothing, man.
Good.
Yeah, had a nice 3-hour winner yesterday. Got another one at 2-hour today. It's been a nice week so far.
So how are you liking the new 4-hour system?
I love it, dude. It's
good, right? It's easy.
It's really easy. The difficult thing is keeping yourself to strict position limits. It works really well when you only take 2 trades at a time, which can be frustrating because you take the wrong I had a trade go sideways in NZD USD for like,
and it ties up the capital. And meanwhile, there's other good trades.
Ties up the capital, but that level of discipline on it, I actually really appreciate. I wanted to be strict with it.
Yeah.
It ties up the capital, but no, it doesn't expose you to large drawdowns, and we should always be focused on drawdowns.
Yeah. So what are you doing? Two positions at most?
Yeah.
Wow, that's really strict. Nice.
2 positions with open risk. So you go to break even, you can have one more.
Oh, so you got to break in. Okay, that's good.
But yeah, it's enough. This system's banging outliers, dude. It's banging big winners. All right, man. You let me know when we're ready to start. I'm just going to grab some more coffee before we get it cracking.
Yeah, grab some coffee, and then I think you can come back and we can get into it.
All right. All right, then. You ready to get it cracking?
Yeah, let's get going. A couple minutes early, but let's get into it. So,
How many people?
Daniel, what do we got?
How many people we got on here?
So far, we're at about 19. So,
all right. Okay, so should we start earlier? Should we start on time?
Let's start early and let's start with the boring stuff. How long you've been trading? Let's go through the boring story, and then we'll get into the price action, everything else.
All right. I'm going to gallop through the boring parts of the story because no one really cares about anyone else except what they know and what they can give the other person.
That's right. That's my opinion, but that's why pregame, 4 minutes.
All right.
Before it's, give your story. When did you start trading? What do you want to, how far back you want to go?
I did a price action mentorship with a famous guy. He came and lived with me for a while in 2002, and I had a few abortive attempts at trading. Didn't take it too seriously. I funded an account with 20 grand, lost it. Funded it again with another 10 grand, lost it. Thought, maybe this isn't for me. Put it to one side as just yet another failed experiment in my life, and then in 2006 I decided, I'm gonna do this stuff seriously. Like, this is what I want to do. And so I went to Amazon. I bought every book I could find on it, and every book. Like, spent a couple of $1,000 on books, read them all. Thought, okay, this time I'm ready to rock. And opened up a futures account with 100K. Took me a few months to lose it this time. and then I dusted myself off and reconnected with my old mentor and said, "Look, I just lost a heap of money. What did I do wrong? I thought I was all good." And he was like, "Okay, well, what were you doing?" I was like, "Well, I wasn't doing what you taught me. That's for damn sure." So I started trading with the system, and that worked all right for a while. But my system wasn't particularly good, and my mentor didn't really. My mentor was very strong on price action and very weak on system building. And so here I was trading this crappy system. I was learning a lot. I was trading properly, but the system just wasn't that strong an edge, and it had big drawdowns. And anyway, I eventually I was in the middle of a big drawdown, and I adjusted the system to go. I adjusted the system, and anyway, that worked. And my last losing year was 2010, and 2011 was a very good year for me. And then
that's around when we started trading. I think right about 2011, 2012, we started developing systems and
so 2012.
And everything else.
2012, I realized that my systems were inadequate, and I wanted to build better systems. So, and I had this situation where, because all the systems I'd had were what this mentor had exposed me to, I needed to see other people's systems. So I spent a lot of time learning Al Brooks' system and Linda Raschke's system and a couple of other people's systems, and I did a lot of work with Van Tharp's Super Trader group, which is Van is the best discretionary system trader, system building guy, but discretionary systems are completely different than mechanical systems. He wouldn't know how to build a mechanical system if one hit him on the ass. You know, he's just got literally zero idea. He's got fundamental issues with back testing. He doesn't understand it. He's a psychologist, not a trader. You know, so I went to
some of the super traders have some exceptional results. So for some people, yeah.
But discretionary systems, he's the man.
It's fantastic.
Yeah.
So listen, 7 o'clock. Let's get started. Let's share your screen. Let's talk about how you look at price, how you look at the markets, and yeah, what do you do each day?
All right, man.
And so you and I, just think of a background. You and I have been trading together now somewhere between the last 5 and 8 years. You know, probably spent the first couple of years developing systems, the last 5-6 years trading them. And we primarily trade daily charts. So that way we have to be at the screens once a day. We look through our universe, 30, 40 futures markets that we trade, and we make our decisions in a systematic way with a very small amount of discretion. But let's take a step back, talk about price action, talk about how we look at price, and we'll take it from there.
All right. So in my opinion, it's like this. There's a couple of fundamental problems that people run into when they start to trade. So problem one is that most of us start with either learning fundamental or technical analysis, and most of us, if we're honest, do technical analysis just because it's easier, and fundamental analysis is more difficult, not necessarily bad. And but problem one is that we get told all this technical analysis. It's all lumped together. It's all technical analysis, and I'm a fan of technical analysis. And so we get this stuff lumped together. We get, you know, RSIs and MACDs and pitchforks and Elliott waves and GANs and fib fans and fib retracements, and it's all thrown into this big soup, and you feel like, oh, it's all technical analysis. And so the first problem is that it's not all created equal. Like, most of this stuff was invented before we had computers to test it, and most of it is crap. Like, at least 80% of what's generally accepted technical analysis is just rubbish. You know, and I realized that when I saw this interview with the guy who came up with the TRIN index, TRIN. And this is a famous dude. Richard Arms is like, he's been a consultant to big hedge funds and merchant banks. And I saw this interview that Vic Niederhofer, who's a very good trader, did with him. And it was just obvious to anyone who had a brain in the head that this guy had never taken a trade in his life. He didn't have any stats at hand as to how often his stuff worked. He didn't care if it worked. He was out giving seminars about it and consulting to banks. And he was just bullshitting his entire life, start to finish. He died last year. His entire professional life was based start to finish on this bullshit idea that he'd farmed off on everyone. And it's so easy believe that stuff works, and it's so difficult to change your mind because we get this confirmation bias. You know, you're trading something that's a negative edge, and it's really hard to admit that you might have been that dumbass who's trading this negative edge thing for years. So that's problem one, is that all technical analysis isn't created equal. Some of it's great, some of it's crap, some of it's in between. And obviously, if you're going to put your scientist hat on, you ought to test everything. If I give you something, if someone else gives you something, the default position should be that anything that I tell you is crap until proven otherwise. That's your default. So the other problem is that while we do what I call dining at the buffet of technical analysis, we say, okay, you know, I can use fib retracements, I can use fib fans, I can pick any indicator and scroll through them until I find one that I like. I can use trend lines, I can use this, I can use that, I can use classical patterns like head and shoulders and things like that. So as soon as I give myself the freedom to dine at the buffet, I'm going to choose the thing that matches my pre-existing view. So what happens is, if I take a bullish view of the stock market, my screen's up now. If I take a bullish view of the stock market, I'm going to be actively looking for technical analysis that supports my bullish view. If I'm taking a bearish view of the stock market, I'm going to be actively looking for TA that supports my view. Now that's rubbish. Like if you had someone testing a scientific theory who came to you and said, I need to, you know, if you had someone testing climate science or whatever, you know, climate change, and they said, okay, I've got this view that climate change is happening and I need to assemble the evidence that supports that view to convince people, a scientist is going to go, no, that's actually wrong. You don't assemble the evidence that fits your view. You assemble the evidence and you base your view on the evidence. So the way I think of it is, are we seeing what we believe, or are we believing what we see? You know, and that's really important. So I'm going to say it again. So are you seeing what you believe, or are you believing what you see? So if we look at the stock market today, this is the E-mini futures, which is the S&P 500 futures. There's two competing views here. Competing view one is that this drop here is the start of a powerful new bear market, and we're just gradually retesting in a long top fashion, and we're going to top out somewhere here, and now we're going to start a dramatic new bear market, turd of a turd wave, you know, and we're going to plummet. That's one view. And the other view is we're going to break out the top here. We're going to squeeze these shorts, and everyone who got short here, and here is going to be forced to cover, and it's going to drive the market off in a very powerful phase of a blow off top.
Hey, sorry to cut you off. Can you turn on that cursor in Ninja so we can see which part you're highlighting? Yeah, do the crosshair. Yeah, that's good.
Crosshair, that sucks. All right. Okay, so we have these competing views, and as long as you're dining from the buffet of technical analysis, giving yourself freedom to just choose whatever you like, you're never going to be objective. All that's going to happen is that you're going to come up with a technical analysis that supports what you already thought. So you know, it's kind of like it's not objective. And what happens when you do that? There's a couple of things. First of all, if you take 10 trades and you're biased counter trend, you're going to take 10 top picking counter trend trades, right?
Yeah, you just take trades to justify your opinion, right? That's what it becomes.
Yeah, and so my idea is that you ought to be testing you ought to be using your knowledge of how price moves on charts, whatever technical analysis you use. And you know, it's all got some validity, not all of it's got great validity, but whatever you use, you ought to be identifying low risk points on the chart. So what is a low risk point on the chart? A low risk point on the chart is a point where the market has to decide. So we have one today. So
As a short setup, right?
As a short setup, exactly so. So let me zoom it in so you can see it. So we have a strong up move in the short term. Okay, we have this bar. The market has tried to go down, completely rejected that downside thesis and closed at the highs. At that point, we know that since the bears have tried and failed to go down, the bulls are probably the bears don't get to try every day. The bulls don't get to try every day. Everyone's got a certain. Both sides have a certain amount of ammunition. When they waste their ammunition, it gives the other side a free kick. So, right here, a couple of days ago, we had a strong probability buy signal, and what this is the fake out setup. Now, I'm going to show you this. I'm going to put it back to the pointer. So, the idea is we have this little bad boy here, which is a spike low. This one here is also a spike low.
And now we define these things specifically. So just to define a spike low, it's a spike low is a low with a higher low preceding it and following it.
Correct.
So it's the lowest low in a 3-bar sequence.
So this is a spike low.
Yep.
This is a spike low. 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 So we can't have an argument. We can't have an argument about what's a spike low. So one of the things that Daniel and I are about is using our price action knowledge to build objective, rule-based systems where it doesn't come down to I like this one, I like that one, I like chicken, I like liver. It comes down to what does the setup tell us, and we see the setup and we take the setup. So the rules for this setup.
So we're looking at the fake out setup, right?
Okay. All right. So point one is we have a spike low. Element two is we have the first bar break that spike low.
Yep.
Setup is complete. Go long on break of the high. Stop at one tick below bar low. Okay, so if we see how this setup works, so one, we need a spike low. We have one right here. Second, we have the first bar to break that spike low, which we have. So what this is if we at this point the market has hit here, what happens when the market hits here? I can tell you for sure any place that there's lows like this, we have stops clustered. So this is what you see sometimes when people whine about, oh, the market maker's gone for my stops. They ran my stops. You whining little bitches are always saying that, right? So you ought to be prepared that if you place your stops in the obvious place, then obvious person is obvious, and you're going to get them run sometimes. Okay, so how do we trade this? We place an order that if the market breaks this high, then we want to be long, and we have a stop here. Now, why is that significant? Because we have a stop in the obvious place. So if the market somehow goes up here and then falls below there, I no longer want to be long. It ceases to be a good long trade. So what this gives us is it gives us mental flexibility. We're not trapped into this idea of the market is going to rally in a strong third of a third wave, and it's going to go to this extension of 1.61, blah, 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 and it's going to stop to the tick right here, and then it's going to do this, and then it's going to do that. We're not saying any of that. I don't know what's going to happen. Facts change. Facts change all the time. So how long are we going to stay in this trade? We're going to stay in until we get a reason to get out. And today we have a reason to get out. So
going with the fake out setup, one of the things we should talk about with these setups is on their own, you take every fake out setup, that's a negative edge. That's not a system. That's not the way we trade. But if put into context, right? And so talk about that a little more.
Okay, so a fake out is not a negative edge by itself. It's just a very small positive edge. So what we do is we build systems around this stuff. So we might define. So in an uptrend, this goes from being a slight edge to a very strong edge at the bottom of a trading range. So if we look at fundamentally, what are we doing when we're reading price? The most important thing about price on any chart is, are we in a trend or are we in a trading range? That's just what we are. And the kicker with it is, if there's any doubt at all, it's probably a trading range. So what I see here is, you can make an argument that we've been in an uptrend for a while, but really this is far from certain. So we probably before we were probably in a trading range. Let me put that cursor back on. Before we were probably in a trading range, bounded by something like this. We broke out of the top of this trading range, and at that point, we became pretty much certain to come and eventually test this high here. Now, how should we treat that? We should treat that like a test. It should be a pass or fail. So if we're in a trending market, like let me add some more data to this, and you'll see what I mean. So if we're in a trending market, we ought to be buying pullbacks in an uptrend. If we're in a sideways market, in the middle of a trading range, things get fucky. And around here, if you can read this price, you're doing better than me. If you can, around here, this is all stuff that is extremely difficult to trade. Whereas on the left-hand side of the chart, we have a clear uptrend. Anytime you get a clear uptrend, and so we have a number of ways to objectively identify that, which there's a number of choices and a number of systems built on. I'm not going to go through it today, but we don't have time. But in an uptrend, this fake out becomes a very, very strong edge, and I'm going to show you. So here we have the spike low. We have the first spike low to break it, and we go long here. Stop loss here. The stop loss is never hit all the way up here. Okay, here we have another spike low. We have the first spike low to break it, which is this bar here. We go long on the break of this bar, which is go long right here. Stop loss here. That stop loss is never threatened all the way up to the top. Here we have a spike low. Here we have the first bar to break that spike low. We go long here. Stop loss here, runs it all the way up to the top. So while we're in an uptrend, we paint winning trade after winning trade after winning trade, because the psychology of an uptrend is all these people on the sidelines who wish they got long back here. So by the time you get to here, you've got guys who've been on the sidelines, who sold out thinking it was about to top, and they're just waiting to get back in. So what this does is it armor plates the advance. It means that anytime there's a significant drop, it means those dip buyers step in and fuck the bears over. Right? That's what it means. And so it changes the fake out, which is one of about 13 different setups that we have and use, and I'll show as many as we get time for today. So what it does is it transforms things from an average edge into a very strong edge, and we can build systems around that. And so what systematic trading does is it takes the heat out of it. It takes the thrill of victory away. It takes the agony of defeat away. Now, let's talk about reading the price bar by bar in terms of price action, as opposed to more traditional forms of technical analysis. So let's say we're looking at this. Let's say we're looking at this chart. One of the things that we know is that in an uptrend, in a downtrend, in any sort of market, the very small candles are unsustainable. And any time that we see very small candles and a sequence of them, this is called low volatility, and this is unsustainable. When we see the smallest candles of all, and you can see that this candle right here is actually the smallest candle on the screen. That's a very strong clue that the market is about to go for a gallop. It's about to go for a run in direction unknown. What direction? Your direction ought to be biased in the direction of the dominant trend until you see evidence that the trend is ending. Now, there's a couple of things that we know about trends, is that trends end in two ways. They either end in the candles getting smaller and smaller and smaller and then gradually falling off the plate, like a 2007, 2008 top, or they end in the candles getting bigger, like here. And the candles of, the candle size, this candle here is, 10 times as big as that. And this candle here is even 5 times as big as that. So when we see big candles at the end of a trend, we ought to become very suspicious that that capitulation has occurred. So what this is evidence that all the guys who didn't have the guts to get long here, didn't have the guts to get long here, they're looking at it going, I'm going to buy a pullback, I'm going to buy a pullback, going to buy a pullback. These guys just sucked it up and finally bought at the worst possible time. So these are the guys. So this is the caliber of guys who bought Bitcoin at 19,000 when they hated it at 1,000. Thought it was a scam at 2,000. At 19,000, they're calling up their buddies saying, "How do I buy some Bitcoin?" It's that exact psychology. Okay, so first up.
I wanted to say one of the first things, right? Anytime you look at a chart, you're always asking, is it a trend or is it a range? Sure. And you have different setups you trade in each, different setups that work in each strategy. So talk about that a little,
So is it a trend or is it a range? It should be obvious to a 5-year-old. What does a trend look like? It starts in the bottom left, goes to the bottom right. This is a trend. If there's any doubt at all, if you can say maybe it's a trend, maybe it's a range, or it's always a range. If there's any doubt at all, it's always a trading range. Why? Because trading ranges happen statistically about 87% of the time. So and we've had that experience, especially if you're following this, standard wisdom, which is you ought to be trend following. Trend following is a frustrating row to hoe, because like 87% of the time the market's not trending and you're holding out for that that little bit of time. Okay, so let me read some price action. I'll show you how we do it, which is separate to the systems that we built. So here we have an attempt to drive the market down, and we've closed at the lows.
Well, it tried to drive it up first, right? Look at that. There's a fall side.
It's tried to drive the market up. It's closed at the lows. So this is,
and it looks like that's it.
So this is nominally an opportunity for the bears to take control and drive the market down. But what we're looking for is the evidence, the next bar, how much. So let's move it to here. So on the face of it, that looks quite bearish. It's a fake out sell. So I would have placed an order to go short here if it broke the low. Now, if it breaks the low, all well and good. It's confirming the view. If it doesn't break the low, what's that telling us? If the sellers are so weak that they, closed here and we can't even get 2 ticks further down, that's telling us that the sellers are just full of shit and they blew their load, right? So look at what happened. We opened up substantially higher. We opened at the lows and we closed at the highs. What does that tell us? It tells us that the bulls were in control at the open, and strongly in control. There was so much buying pressure that it gapped it up from here to here. And then despite controlling the open, the bulls hadn't just blown their load. They'd forced it all the way to the top and controlled it right to the close. So to me, what that tells us is that these bears have made a catastrophic mistake. This is a bad fail. This is a bad miss. So maybe 65% of the time, the bears would at least start some mean reversion down to about at least here, right? So one of the things that's axiomatic when you read price action is that low probability outcomes cause really big moves. So if something is so one of the reasons why it's so difficult to predict far into the future is that if something doesn't happen that should happen, then it's going to cause a bigger move in the opposite direction. So it's like a surprise. Okay, so here we've got the bulls in control and we have an inside bar. Now, an inside bar setup is a bar with a lower high than the previous bar and a higher low than the previous bar. And it fits inside, completely inside this bar. How do we trade this? In an uptrend, we go long on a break at the high with a stop at the low. Okay, so this bar, what's happened? We've got into the trade. We should be long. The range of this bar is about the same as the previous bar, slightly less. So it's not running out of steam. It's not kicking off super strongly. We have some selling pressure at the end. So this upper wick, we've got what, about 20% of upper wick is people selling out their positions at the end. They've got a decent profit they're selling out, and we have very little overlap with the previous bar. So what is this telling us? This is telling us that the market is testing these old highs here and testing these new highs and saying we like these new highs. Some people have sold out, but not that many. So the next bar, we have one of the things that we look at is at the start of a move, we're looking for signs of strength. Now, one of the best signs of strength is what's called a micro gap, where there's a gap between the close here and the open here. And you can see it's only a couple of ticks, but what that You there? Daniel.
Yeah, you back? I think we lost you for a second.
Yeah, you lost me for a second. Has everyone got me back?
I will let you know now. Yeah, you're coming back in a couple seconds, so you're good to go.
All right. So one of the things that we look for at to decide, is this a move that's just going to run out of steam now, or is it a move that's going to have some legs? Is it going to be tradable? One of the things we're looking for is micro gaps. So a micro gap is a hidden sign of strength. So we've got a small gap between the close and the previous open, not necessarily above the high, just between the close and the open, and we've got a couple of ticks. So what that tells us is that the institutional buyers who drive the market were so convinced that the shit is going to keep going that they were willing to bid it up just to get positioned here, because they know that it's probably going to close higher. Now, if we look at how much overlap we had between these two bars, we've got a very small amount of overlap. We've got slightly more, but still a small amount of overlap. This bar is about the same range as the previous bar. So we're not decreasing in strength. We're not increasing in strength. We're just steady marching to the upside. This is the type of market that goes on for a while. We have exactly the same thing, except we're closing right on the highs. So what does that tell us? It tells us that the bulls have controlled the open. The bulls have controlled the close. The bulls have got it in a lockdown on cruise control. We're just steady marching to the upside here. Okay, now we have, so why did we steady march up for 5 days? Because the bears blew their load back here. The bears, every time one side or the other blows their ammunition, it takes 4 or 5 days to get set again. And you can see it here. The bears have had a crack. It took 1, 2, 3, 4, 5 days before they had another crack. Bears had a crack. It took a little longer to have another crack. The bears have a crack here. It takes a little longer to have a crack. So here we see this bar, very small range bar. We see the market has tried to go down and failed and closed at the highs. So the bulls are still winning, and the bears have used some ammunition trying to sell out, trying to reverse the course here. That's not good for the bears. Okay, so now we're seeing signs that the market is weakening. So what is this bar here? We're still closing up, but we have substantial upper wick. Upper wick is selling pressure. So what that tells us is that the people who got in here are all of a sudden increasingly happier just to take their profit and walk away. So if you're in a trade like this and you see this kind of price action where everything was good and now the bars are getting smaller and we're seeing upper wicks, this is a time to tighten your stop. This is a time that it could keep going, but if you get some adverse market weather, it's not a trade you want to be in anymore. Okay, so here we see one more attempt to drive the market down, and it closes up. This is a very key concept. This candle here is what's called a hammer candle. Now, a hammer candle we objectively define, like everything, as a candle that has two characteristics. Characteristic one is it closes in the upper half of the range. Characteristic two is it has a real body. The real body is the colored bit that is equal to or greater than 2 times the lower wick. So basically, it looks like this. It looks like a nail. And what it is a failure.
But just to jump in, I think that's the key part. The mathematical definition just makes it objective. So when you're looking through it, you're not just going, oh, well, that's close enough. That's a hammer. You're specific, and I think that's a big part of that. You know.
Exactly so. So how do we trade hammer candles? In an uptrend, hammer candles are a strong edge. If it breaks the high of the hammer candle in the next bar, you can place a stop at the low and get long. Now, if it doesn't break the high, there's something else in play. Like you can see here, here we have a hammer candle, but it doesn't break the high the next day, and it's going to give a bit more downside. So, all right. So after the hammer candle buy setup, we place an order to go long here, stop at the low. It works. Obvious. And now why does it work? It works because we had evidence of weakness, which is going to attract the shorts, right? The bears drove it down here, tripped on their own dicks, ended up here. If you're a bear who went short and you see that, are you feeling good about going short in that market? I'm not. I'm thinking I've made a bad mistake. Now, where are the places that you get out? So you want to go from being that guy that the market makers are fucking with all the time by taking their stops to being the guy who knows where the stops are and trading alongside of that. You want to be the guy who's fucking other people's stops over rather than the guy who's getting his stops fucked over, right? So where are the other guys' stops? In this situation, if I got short here, and at the end of the day, there's 2 places. There's 3 places I'm potentially gonna get out. The first is just exit at the end of the day. Say, okay, I made a mistake. I just got to get out. The second is place a stop at the high of this candle, which is here, and the third is place your stop up here. So we have a situation where all 3 of those can trigger off this sort of cascading thing where, first of all, people exiting their trades drives it up above this high where we have some stops, and those stops triggered there drives it up to here, and then that kicks off a whole new thing, and then that makes all these guys who got out here want to finally jump back in. So you can see what happened here. Exactly that's happened. So it's driven up above this old high and closed above it. Very little selling pressure at the old high. So what's that telling us is that everyone who got long here is very happy with that. No one's banking profits. Everyone's good. We're good. I'm long here. I'm good. I'm not selling. Okay? Again, is there much selling pressure? Tiny, tiny bit of selling pressure. Go up to the highs. We're good. You know, we're closing at the highs. As long as we're closing at the highs, what's that telling us is that we have insignificant selling pressure. And why do we have insignificant selling pressure? Because the bears blew their load here. after their bears blew their load. Here we can reasonably expect at least 1, 2, 3, 4 days before they're really going to get their shit together. Okay. Here we have a micro gap. The close is 2797.75 and the open is 2798.25. So we have we have a small micro gap, which is telling us that the range is very small. So the range is probably going to be increased the next day, and the market is gapping up. What it tells us when we gap up at the end of a big move is that people are capitulating to that trade. So when we have a gap up, it tells us that new longs are getting positioned that didn't have the guts to get long here, but now they have the guts to get long. So what these traders have done is they've traded profit for certainty, which is always a sucker play. Your best trade should feel kind of greasy. It should feel like, yeah, it's a trade, but I don't know about this one. Maybe it works. It shouldn't feel like a slam dunk. If your trade feels like a slam dunk when you get in, like this trade would have felt like a slam dunk to buy the open, you're probably about to get fucked. So what's happened in the next bar is very, very interesting. So this is called an outside bar. Now, an outside bar is a bar with a higher high and a lower low than the previous bar. Objective definition. So what's happened here is that the people who were betting on going short got fucked out of their positions first, and then or maybe in the opposite direction, and the people who got long yesterday also got fucked out of their positions. So basically, everyone got screwed out of their positions. All the guys who were here. So what is the implication of this? We don't have these strong hand guys from back here anymore. After an outside bar, you have a whole bunch of new guys. So anything that looks like a spinning top candle, anything like this. So what we can say is we've got a bunch of fresh participants in the market. Fresh participants in the market, by definition, don't have the guts or the wherewithal to hold. If you bought here, this drop doesn't concern you at all. You just laugh it off, right? If I buy here, this drop concerns me greatly. My ass is puckered. So what is the implication of that? Statistically, and we've done a huge amount of research on this, when you see these candles at the end of a major run, typically on average, we have 3 point something bars before a major top. Okay. So I
think probably another way of saying that is that outside periods happen at or before a market turn.
It generally happen a little before, but so what an outside period is to me is a signal that I don't want to be playing in this pond right now. So we have the market continuing to go up so any kind of strong uptrend, you have a bunch of guys who wish they were long who just haven't had the guts to pull the trigger. They will buy any pullback, and which is what they've done here. So in context, we've got a market which is fragile but still going up. So a fragile market is a market that's prone to falling off the plate. Okay, here we have an inside bar and a very small range. This is not behaving right to the upside. I would not want to be long this market at this stage, even though it's going up. So we have a failed attempt to drive the market down and a close at the highs. It's going up. It's going up some more. We have another outside bar. So at this stage, you don't necessarily want to be catching the top. You don't necessarily want to be catching the last little bit of this. This market is becoming a market that's shaking people out of their positions again and again and again. And we have another inside bar. Resolve to the upside. So the market is still going up. It's shaking off its weakness. The market is much stronger than it should be. And now we're starting to get weakness. So what's happened here? At the top of this candle, we ought reasonably to have kept going. This is unequivocally bullish. it's an uptrend. We're getting quite big candles at the end of a very extended run. This is like almost it's a lot longer than 1 month of run. I would be very cautious about taking long positions at this time. Also very cautious about taking short positions. So where is the safe place to take a short position is after a retest. So,
and that's good. That's where I was hoping you were going to get to next, is talk about the retest and how we use that setup.
All right.
Because that, I think, is one of the most powerful setups which we use, not just for reversals, but for trends as well, because it just occurs frequently enough that you can build full-blown systems around it. So,
okay, so what is the definition of an uptrend? An uptrend is a market that makes higher highs and higher lows. It steps up like a ladder, right? At what point is it safe to go short? Because it's certainly not fucking safe to go short anytime here. Like it's really difficult to go short. The time that it's safe to go short is when this pattern of higher highs and higher lows is broken. You can see that right here we haven't made a higher high. So at this point, now we change the pattern. So what is the point of recognition? The point of recognition is right here. That's like, oh, wow, this is no longer behaving like an uptrend. So that is the point. So when we see a couple of outside bars, I'm looking for a place to get position short with a very small speculative position, but I'm waiting for a setup to do it. Okay, so here, what do we have? We have a micro gap, I believe. So the close is 28.61.75. The open is no, we don't have the micro gap. Okay, now we have a setup. So this rally up to here is exactly this, but in pattern form. Now, what we have is a number of objective rules-based setups that can identify this exact point where it's safe to go short. Now, how does this work? Let's look at the rules. So rule number one is we need a significant high. What's the definition of a significant high? It's the highest high in 10 bars. Element number two is we need one or more lower closes. Lower than what? Lower than the previous bar. So yes, we have a lower close than the previous bar. We have another lower close. Cool. That element is fulfilled. Element three is we have a higher close than the last bar to make the lower close here. So our close here is 28.31.75. Oh. Our close here is 28.31.75, and our close here is 28.34.75. So we definitely have a higher close. How do we play this? We have two ways to play it. We have an aggressive and we have a safe. Let me take this stupid cursor off. I had it. The aggressive way is to enter on a break of the low, place your stop above the high. You can see we got a massive move. The safe way to play it, which is what I mostly do, is to place the stop above the significant high. So we get short the next bar here. Now it's safe to be short, and then you can see the big drop happens. Now, stock markets and FX markets don't behave identically. The stock market behaves radically different to the short side than the long side. Now, FX markets don't do that because FX is just an abstraction. You can just turn the chart upside down. But especially beginner traders get themselves in a trap by thinking that the long and the short side isn't the same. It's different in a number of key respects. You need to borrow the stock to go short. So professional investors have some hurdles to jump through. And a successful long, if I buy here, by this time here, my long is growing. My long position is growing in value. If you short something and your short actually is successful, your successful short shrinks. So it's a key difference that that fucks with beginner traders. And it doesn't sound like much, but it's actually a really big deal. And the other thing that you might have noticed is that at the point, if you get a day, this would have been a day where like 9 out of 10 stocks finished closed at highs. This would have been a day when 9 out of 10 stocks closed at highs, right? If you get that same day on the bearish side, when 9 out of 10 stocks closed at lows, it looks like this. Now,
hey, add your cursor if you can.
I can't.
Add the crosshair or just arrows or something.
I hate that shit, man. Okay. All right. So the short side in stock markets, you want to get out at conceptually, you want to get out at the moment where it feels like, fuck yeah, this is going to zero. The moment when you're jumping around going, this is the time, it's bear time, it's going to work, it's going to fall to zero, the 10-year bull market is done. It's done. Stick a fork in it. It's fucked. That's the exact time that you want to get out. And that's a key difference between stock markets and other markets. And you can see what's happened here is that this is probably...
So would you say the stock market is far more mean reverting than other markets?
That's a question that's not a story. That's the question. That's a number. So you apply stationarity tests and a mathematical test called the augmented Dickey-Fuller test to it, and what it shows is that stock markets are strongly mean reverting in the direction of the dominant trend, and not mean reverting much. Not mean reverting nearly as much counter trend. FX markets, only a few FX markets at any given time are mean reverting. They're, the ones right now that are mean reverting are USD Mexican, USD CAD, and Euro CAD, I think, from memory. So anyway, so what we have here is capitulation to the downside. So that old thing about the markets take the stairs up and the elevator down. In one trading week, we've wiped off 6 months of gains, right? And we've wiped off 2 months of gains. So if you had that situation to the upside, you'd be hanging on thinking it's the start of a powerful bull market, but it's not the case in the stock market. If you're short, you want to get out when the going's good. You really do. And what we can see here is that there's two aspects to markets. One is are they trending or are they range bound? The other, are they low volatility, small candles like this, or are they large candles like this? Now, what is the impact of volatility on markets? It's huge. It's everything. So in high volatility markets become unpredictable. You need dramatically wider stops. So if I'm gonna trade this, I need small position sizes, massive stops. Here I can get away with tiny little stops. You see what I mean? So in high volatility times, we have all these cross currents. So if you think about what it's like to be, so that's the previous market. Let's look at a bit more of it. Like, that's a hell of an uptrend. That's a hell of a bull market. At this point, the bears can make the argument that the character's totally changed, and the character totally has. And so if the character's changed, the obvious implication from that is that we're not in a bull market anymore. Maybe we're in a sideways market. Maybe we're in a bear market. But we're certainly not in a bull market at this stage anymore, right? What makes it a bull market again? What makes it a bull market again is if we get above this high. Then it's a bull market again, but it's a different type of bull market. It's a high volatility bull market. A high volatility bull market is another phrase for a blow off top, and a blow off top is something like happened in Bitcoin last year, something like what happened in the .com bubble. So a blow off top is typically the final stage the most unpredictable stage, the bucking bronco stage, where the market could shoot up 30% in 6 months easily and then fall off the plane. But it has to get there first. So we've got these cross currents between, dip buying bulls who I've got 6 months, I've got a huge discount. We've got short who are banking profit. We've got guys who bought 2 years ago who are calling up their brokers going, what's happening? Should I sell? So you've got a lot of emotion in the market, and emotion is a proxy for volatility. The more emotion we have, the more emotion we have, the more strong opinions we have in the market, the more movement we have, the wider stops. Guys, I think we're running close to our allotted time. So, Daniel, did you want me to present a product or anything like that?
Yeah, no, I think we can just mention that it's available. So we put together, what was it, about a year and a half ago, we put together a price action course. And yeah, I think for the first week we're doing a special. It's $99, but we're also throwing in the toolkit in there, which we usually charge an extra $99 for. So that thing is free for the first week. So yeah, talk about the class a little bit. What are they? What will you learn in there? Who is it good for? Who's it appropriate for?
Okay. So what we've got here is a thing called the Price Action Masterclass, which Daniel and I built. It's a video course on how to read charts and how to read them exactly like I do. It's everything that I know. It's everything that I've accumulated from all my previous mentors and everything I've come up with myself. So with that and the setups toolkit, which is included, which is all the setups that I use to build high probability trading systems out of, you're going to be equipped to do two things. You're gonna be equipped to read the charts much better than with indicators, because indicators have fundamental problems. In a bull market, you're going to stay overbought for a while, and indicators only work great in sideways markets. So what it teaches you is two things. One is a more efficient, more granular, more detailed way of reading the charts that tells you stuff before you get it from other methods. So for example, here, we saw the outside bar and we know, hang on, we should become suspicious that we're going to form a top, because tops often happen, within a couple of bars of outside bars, and 1, 2, 3 bars away, we've got a top. So you get a level of granularity and detail that it's just impossible to get with reading the charts through indicators or trend lines, or you wait for a trend line to break, and sometimes it's a false break, and so on and so on. And the other thing that I think is best trading practice is to take these principles and to identify a low risk point on the chart to get positioned. What's a low risk point in the chart? A low risk point in the chart is not a point where you know what's going to happen. A low risk point is a point where if you're going to be right, you're going to have a big winner. But if you're wrong, you're going to have a small winner. You're going to have a small loser. So if we take the example that we took here, where we went, short right here with a stop here. If we're wrong this much. If we're right this much. That's the essence of a rational bet. Now, no matter what sort of technical analysis or what sort of trading that you're trying to do, what you ought to be doing is placing a series of rational bets. What's a rational bet? A rational bet is a bet that if you take it 1,000 times in a row, you're going to come up with money at the end of 1,000 times. Exactly like, so you want to shift away from being the casino participant to the casino owner. So the casino owner, he's not like, he sees me walking into the casino and he's not going, oh shit, Scott's walking into the casino. Oh fuck no, that guy. Oh no, not him, not again. Oh shit, he's putting it all on red. Oh no, come on. He's not like that. The casino owner is just like, I know that in the long run it's going to play out because the odds are on my side. And so that's what we want to shift to in our trading, is away from, I know what's going to happen next. No, you don't. I don't know what's going to happen next. You don't know what's going to happen next. Daniel doesn't know what's happening next. We get it right. Sometimes we get it wrong in others. And our brains as human beings are so retarded, we only remember the times we get it right. You know, we've all got this incredible short memory motherfuckers thing to us, right? So we want to move away from trying to get it right every time to trying to get it right enough that our winnings are more than our losings. So win rate is the least important part of trading success, as long as your winners make you more than your losers. So anyway, so what we have is I think it's a really good product. We've got great feedback. We've sold thousands of it. It's really cool. I recommend it and I stand behind it, and I offer a lot of support for it. If you're looking to learn how to read the charts in a better way, and if you're looking at building trading systems, which everyone ought to be building trading systems, you know, ultimately, this type of trading where you're like, I think this is going to happen tomorrow. I think now we're going up, now we're going down. This is possible. I can do it. I've done it in the long term, but it's a very difficult, high stress, high skill way to go. So what you want to in the long term, you want to transition away from this, which is very difficult to maintain, and build yourself some trading systems which are pretty easy to maintain and pretty easy to do. Like when I go on holidays, Daniel runs my trading systems for me, and he does them exactly like I would. There's no difference. It's like we're identical.
Maybe I can do them a little better than you.
You can actually, because you're a lot neater and more organized than I am.
You come back, and the spreadsheets are a lot more organized than you left them, right?
Yeah. Daniel's a lot better execution trader than I am. I have to say, he's when we go head to head, he beats me. So anyway,
I have no ideas for building trading systems. It's like that's not my forte.
We're a good team. So anyway,
yep.
So guys, I've really enjoyed presenting today, and I hope
So thanks everyone for joining. Thank you to Jacob, Brad, putting this together. WeTradeHQ.com. Anybody that found us on YouTube and just seeing this, so that's WeTradeHQ.com. You can see the course. You can join the community.
Can you give me a link so I can show it before these guys go?
Yeah, it's WeTradeHQ.com.
Okay, now where can we find the link to this product?
It's right there on the homepage. So if you log in, you will see it. Scroll down a bit, and it's right there.
Okay, so buy this, you get all the bonuses that we charge a lot for. You can have it for $99 today. I think it's a screaming deal. Certainly a better deal than I've ever offered on my site. And honestly, guys, you should buy this. This is going to make more of a difference than anything else that you could come up with today to your trading. So thank you very much, guys. Go buy this product right now. Don't make me come.
Thanks everyone for joining. I know, Scott, they get together in the mornings to trade U.S. hours. You and I are a little different. We trade about 5, 6 o'clock East Coast is when we trade and get together. So we'll sync up, I think, for questions in the future. Anybody can reach out to us. Scott at scottphillipstrading.com is your email. So any questions, if anybody, is unsure about a rule, the retest setup, the fake out setup, even if you don't buy the course, shoot us an email. We're happy to help.
Yeah, happy to help. All right, guys. Be good, man. And women. Bye.